Good morning and welcome to our weekly edition of the Ashworth Wealth Market Weekly Market Update. Welcome and thank you for joining us. We have a little bit to cover today. We're going to talk a little bit about the wage growth and how that's impacting inflation, and a little bit just about the economy as a whole. These slides were done before the news that we had on Friday of the bank collapse of the Silicon Valley Bank, and we're going to talk about that for just a little bit and maybe put that into perspective as far as where things are at and what we're seeing. In fact, let's talk about the wage growth first, and then let's move over to talk about the Silicon Bank. So as we look forward, as we look to this, we've had a lot of talk recently about how tight the labor market is and the unemployment rate, and how the unemployment rate that the Fed wants to take that a little bit higher. And one of the things that we look at is there's an even more closely related statistic that's related to inflation than the unemployment rate, and that's the wage growth rate. And the wage growth rate is basically how much more people are making today than they were, or how much additional corporations are having to pay individuals now versus before in order to hire and bring people into the workforce. And so wage growth is an important component and probably is the most closely related to inflation of any of the labor market statistics that we have. So we're going to talk about that for just a minute. And you can see here that wage growth, you can see that we're coming down in the growth rate, but that we're still above 5% here going forward. And as far as the number that we need to be hitting is that the target for the Fed is about 2% that they're trying to hit with inflation. In order to hit a 2% target, we're assuming that this needs to be at about 3.5%. So you can see that this wage growth still has to come down quite a bit before that 2% probably is realistic for the federal inflation rate. Now, as we talk about that, we get to also pivot because what happened last Friday is a huge indicator of the disconnect in the marketplace between the data points and what the data points are showing with regards to wages and wage growth and inflation and all of those types of things versus real life, what's happening in the economy and what people are experiencing and what individual corporations are experiencing. So this is a really good way to look at this, in that this Silicon Valley Bank took out bankruptcy last Friday. Their stocks plummeted. People did a run on the bank, and everybody wanted to go take their assets. And all of the creditors, first of all, let me just state that all of the creditors are going to be made whole. The FDIC insurance is going to come in and back them up. And so the loss as far as the individual depositor probably is pretty minimal, the risk of loss as far as assets that they've deposited in that bank. And so that's really not the concern right now. The bigger concern is just that Silicon Valley Bank was one of the third largest banks in the United States. There's another bank in New York that has also been put under protective care, a New York bank. The interesting thing, or the common denominator between these two banks, is that they both specifically deal with, or traditional, or very specifically their market niche is the technology industry. And so we're seeing stresses in the technology industry. The growth seems to have been hit in the market a lot more than your other types of asset classes. Asset classes such as industrials and consumer goods and those type of things just seem to just keep chugging along, but the tech industry really has taken a lot of the brunt of this last market downturn. And so it brings to bear a number of different questions. Before I go to that, though, let me just kind of finish my thought process, because I'm trying to think of things as we go forward here of what might be beneficial for you. So one of the things that we learned about Silicon Bank is that they were taking quite a bit more risk with their assets than traditional banks are. And let me give you an example of what happened and how it impacted them. So with the Fed increasing interest rates, Silicon Bank, instead of putting their money in retail, actually had an oversized amount of their assets that they had in their deposits in specific investments. So rather than being a bank, they were using it more as an investment corporation to invest in various areas of the economy. And one of the areas that they invested very, very heavily in was in treasuries and also government-backed securities. So even though if they wait until those mature, their whole assets, and they don't have to worry about default on those, what has happened is because interest rates have increased over the year, over this last year, and increased substantially, and the bond prices have reflected the downturn of the bond market. In fact, the bond market was down about 15% last year. What has happened is that those deposits now have gone down substantially, and when they reported on that, people started taking their money out of the bank. And because people were taking their money out of the bank, and because their deposits weren't as high as what they should have been, thus caused the shutdown of the bank and the federal regulators to come in and take a look at that. So a couple of things. Number one, the Fed have stated that they're going to back it up. President Biden announced that they're going to back it up. They're doing a loan to the bank rather than having it financed by taxpayers. And so the deposits are going to be made whole. But the point that I'm trying to make is that this is illustrating, in the one hand, we have this chart here that says the economy is still way too strong. And on the other hand, we have the banking system that has had two major banks fail in the last week. And that is just showing that there are significant stresses in the economy. And so one of the things that we're going to be watching going forward is how the Fed reacts to this. We haven't had any news specifically out of the Fed as far as how this is going to impact their thinking and what they're going to do as far as continuing to raise interest rates or not raise interest rates. But I am sure that they're looking at this very, very closely, just because of the disconnect between these two marketplaces and the disconnect between what's going on in certain sectors of the economy and other sectors of the economy. We anticipate, as far as the best that we can see, that this is not going to be a contagion event, that it's not going to dramatically impact long-term the returns for the market for this year. More than likely, it will impact. In fact, it has already impacted the market short-term, and those things are natural. But over the rest of this course of this year, I'm not sure that it's going to have a very big impact on what's going to happen for returns in portfolios through the end of December of this year. So again, we've mentioned this before. We expect continued volatility in the marketplace for this year, but we do expect that things are beginning to heal in the economy. And it's just kind of a waiting game to see how things flush out and where things are at. But long term, we're watching these things from a planning standpoint, from a goal standpoint, and making sure that you're still in the best position that we can have you to make sure that you're accomplishing your goals. And with that, we'll sign off for today. Thank you so much for watching. And if you have friends, neighbors, co-workers, etc., associates that you'd like to forward this podcast to, you're more than welcome to do that. We would greatly appreciate it. And we will see you next week. Thank you so much for tuning in and being part of our weekly market update. Thank you again.